So we've spent a lot of time talking about the Federal Reserve, banks, how those two are connected. Let's now bring that to you. Okay, let's move this from the banking sector into Main Street. Let's think about how the Federal Reserve affects you. And the primary way we can think about how the Fed affects you is to think about interest rates, specifically those rates that we've been discussing. The discount rate, federal funds rate, and the interest rate on reserves. It could be in a scenario that looks something like this, and then we can imagine how this would affect you. Okay? At some point during your life, in fact, throughout most of your life, you're going to be both a saver and a borrower. All right? I bet everybody watching this video right now is a saver in the sense that you have a checking account or a savings account, stocks, bonds, something like that. And frequently you'll also be a borrower. That could be through a mortgage, a home loan, student loans, or it could be something like a credit card, which, if you're paying off your balance in full, it may not feel like borrowing, but still in reality you are borrowing from the institution. So let's think about how these rates affect you. Let's start with a mortgage. In the case of a mortgage, the consumer person, the borrower, right? They're the borrower. And that makes the bank the saver. Now, it kind of sounds weird to call the bank the saver, but remember that saving and lending really mean the same thing in economics. Anytime you save or lend money, you're putting money away to get more in the future, okay? So let's think about how these rates would affect you. The bank has a couple different options as a saver. If a bank wants to save money, in this specific circumstance, it could save at 3% or it could save at 2%. So given that information, what interest rate do you think the bank is going to be charging those getting a mortgage? Would a bank ever give out a mortgage at 1%? No, that'd be really dumb, because a bank can save money at 3%, right? Would a bank ever give out a mortgage at 10%? Maybe, okay? Because this discount rate does not affect the banks that are saving, right? The ones that are lending. You can't lend money to the Fed at 5%. That's not what this is telling you. This is showing you what rate you can borrow from the Fed if you're a bank. So it turns out, for something like a mortgage, the rate that you're charged will be at least 3%. Okay? So that federal funds rate effectively serves as a floor on the interest rate for things like mortgages, car loans, student loans, etc. So why do they charge so much more than 3% most of the time? Well, it has to do with the quality of the loan and the risk of the loan, okay? In the case of something like a mortgage, there's risk. And the risk premium refers to the extra interest they're going to charge the borrower. Because if a bank wants to lend money to another bank, that's practically risk-free. But if they lend money to you, you're risky, so they're going to charge you more. So this is the extra interest charged to you to offset the risk. Right? There's always a chance that the person won't pay back in full. And beyond that, there's other things we should worry about, okay? We'll talk more about these in the future: interest rate risk, inflation risk, etc. The second reason has to do with liquidity. If a bank lends money to another bank at 3%, that money is going to get paid back very quickly. All right, that's a good thing, right? Think about loaning money to a friend. If you loan money to a friend and they paid you back 10 minutes later, you would charge them very little interest, right? You'd be happy to charge them practically no interest for that loan. Now imagine a circumstance where you loan a friend $100 and they pay you back 20 years from now, all right? Not only would you consider things like risk as being an issue, but you'd also consider the fact that it is so long before you're going to see your money again, you would want to charge them even more interest, right? In other words, we all prefer to have the money in hand. We all prefer to have money right now. So any further into the future that the money comes to us, we discount that value, okay? So the liquidity premium is the extra interest to compensate for the waiting for the funds to arrive. All right? It's the extra interest to compensate for waiting for the money to arrive. So if something is perfectly liquid, that would be like money in your hand. Cash in your hand is like perfectly liquid. One way to make that money not liquid is to turn it into something else. So instead of holding cash, you might be holding silver, right? It's not as easy to transact. It's not as easy to spend. Another way to reduce liquidity is push it off into the future. $20 in my hand right now is extremely liquid. $20 that I know I'm getting tomorrow is less liquid because I can't use it right now. So there's also a liquidity premium, okay? So for these reasons, and even some more that we could tack onto this, the interest rate that the bank charges is going to be more than 3%, right? Largely because the borrower is more risky when it's something like a mortgage, and the borrower is going to pay it off very slowly, right? Most mortgages are 30 years. So that 30-year period is it's something that banks don't like. So they're going to have to get compensated for doing something they don't really want to do, all right? So all that being said, just recognize the federal funds rate serves as a floor for the loans that banks are going to give out to regular consumers, be it a mortgage or any other type of loan. Now let's flip this around. Let's think about the circumstance where the person, the consumer, is the saver. So a second example could be a savings account, checking account, CD. There's lots of different things we could put here, but I'm just going to go with savings account, okay? In the case of the savings account, the consumer is the saver, and that makes the bank the borrower. And sometimes people don't like to think of this way. You know, it's kind of weird to think of the bank as the borrower. That's really what you're doing. If you're taking your money and giving it to a bank, they're borrowing it from you, and they're using it to make loans and such. All right? You're the saver, you're the lender, the bank is the borrower. So in this circumstance, the bank has a couple of different options. If a bank needs to borrow, it could go borrow from the Fed at 5%. It could go borrow from the other banks at 3%. So given that information, what interest rate do you think the bank is going to give you? All right? If the bank needs to borrow, they can borrow at as low as 3%, right? So if you need to save your money at the bank, all right, the bank is never going to give you more than 3%. If I go into this bank right here and I say, I would like 4% on my savings account, the bank's going to say no. You know, there's no point in us doing that because we can always go in and get money anytime we want at 3%. Why would I take your money at 4% when I can get practically infinite amount of money at 3%? Okay? So in this case, the federal funds rate is basically the ceiling. So the savings rate that you get will be 3% or less. Okay? 3% or less. So to take all of that in, all right, the federal funds rate, which we know is bounded by the discount rate and interest on reserves, it itself could go to 5 or 2 in this example, okay? That federal funds rate is going to serve as a ceiling when it comes to consumers saving money, and it's going to serve as a floor when it comes to consumers borrowing money, all right? So keeping all of that in mind, let me show you where we are right now in the United States. Now, I'm recording this in February of 2020, so things could change in the future, but at this moment right now, here's where we stand. The discount rate is 0.25%. The interest on reserves is 0.10%. And so where would you guess the federal funds rate is if you had to guess? All right, 3%, 0.05%? No. It's going to be between these two, right? And in fact, the federal funds rate is 0.1%, right at 0.1%. So what that tells us is at this moment in time, the interest on reserves is serving as a binding price floor. Okay? Looks like this. Here's what we got going on here. Savers, borrowers. That's what it looks like. Okay, it's a binding price floor. There is more money saved than there is borrowed by the banks. And in fact, where are these extra savings going? They're being held at the Fed. Just look at the data. Over $1 trillion right now in excess reserves is being held at the Fed. In other words, banks have money that they can do whatever they want to. It's not required reserves, it's excess reserves. They're choosing to hold it at the Fed to get that 0.1% interest in a lot of cases, okay? So there's still tons of money being borrowed and saved in the market for the federal funds market, right? This market still has money being exchanged, but then there's extra money also being saved at the Fed. So this is what this looks like right now. So given that information, we can think about interest rates. In general, will interest rates be high or low in this economy? Let's not just think about these, but think about mortgage rates, savings accounts rates, CDs, everything, okay? Interest rates in general, they all move together. And they're all driven by what's happening with the federal funds rate. The federal funds rate represents the bank's rate that they could save at and they could borrow at, right? This is the rate that they could save or borrow their money at any moment. So what that means is all other rates are going to go lockstep with that, okay? This rate informs rates throughout the entire economy. So what we would expect to see is mortgages, student loans, etc. They're all going to be set up to be at least 0.10%, okay? And of course, they are above that always right now in the United States. I just got a mortgage for a house. The interest rate was 2.875%. That's kind of the standard rate right now for a 30-year mortgage. And so what this shows you is the difference between these two is driven by risk. There's no guarantee I'm going to pay them back. And that liquidity premium that we discussed before. So we got a risk premium and a liquidity premium that explains the difference between those two values. Then we could think about savings accounts and what we would expect to see. For savings accounts at banks right now, we would expect interest rates to be at 0.10% or less, okay? Truth be told, sometimes it can go a little higher. It has to do with marketing and other factors that banks have. If they can get you to be a customer, they think they can make money off of you in other ways. So sometimes they'll use this like a loss leader, all right? But for our purposes, we would expect it to be at 0.10% or less. And in fact, if you look at savings accounts rates for most banks, don't go out there and search for the very best one. Just go to your neighborhood bank and ask them. Their savings accounts rates are probably going to be in this neighborhood a little below this, okay? So we can occasionally get in some weird circumstances where we deviate a bit, but the bottom line is the federal funds rate drives rates throughout the rest of the economy. What banks can save and borrow in the federal funds market will serve as an indicator for what banks are going to do in all markets. Now, let's take it one step further. We just talked about the Fed and interest rates. Now let's think about the Fed and the economy as a whole. I want to make sure we understand why the Fed can stimulate the economy through changing the money supply. And it's not as obvious, right? The simple answer, the principles of macroeconomics answer is, if there's more money, the economy will be better, all right? Well, why? Why is that the case? Turns out there's a lot of reasons why this is the case. We need to understand them, okay? So this is going to be the Fed and expansionary policies. Back in the Keynesian part of this class, we talked about expansionary fiscal policies, cutting taxes, right? Increasing government spending to expand the economy. Now we're going to talk about expansionary monetary policies. Expansionary monetary policies, of course, have to do with increasing the money supply. So, Here's the question I'm going to ask, and then we're going to try to answer why this is the case. Why does an increase in the money supply stimulate the economy? I'm going to give you a handful of reasons why we think this is the case. Okay? So let me start with number one, which I think is probably the most well-known, but we're going to add just a little bit of a wrinkle here to it. Let's think about the effects of more money on prices and spending. So everybody tends to have this common belief. Again, the principal's belief is when there's more money, people spend more, right? If there's more money around, people spend more. But that begs the question, if there's more money, why don't businesses just raise prices and that would negate the effect? In other words, think about it this way. If the Fed announced that tomorrow they're going to double all their prices, right? Or excuse me, if the Fed announced they're going to double the money supply, double how much money is in existence, then the predictable response would be that businesses would all double their prices, and then the economy would be exactly where it was, right? Just with everything being twice as expensive, right? Wages would double, prices would double, money supply would double. It would all kind of cancel out, right? So here is what we need to recognize. Prices are sticky. Prices are sticky. They're not easily changing, okay? Now, prices move faster than wages. Prices change faster than wages. So if we look at a bunch of economic data, what you'll see is prices are a little more fluid than wages because wages have contracts and such. But prices are still a bit sticky, or in some cases we refer to this as rigid. There's some price rigidity, okay? So here's one reason why. Menu costs, okay? A menu cost is a cost that occurs when prices are changed. Okay, now let's make sure we understand the difference between cost and price. Price is the price you're selling an item for, okay? Whereas cost is something that makes it more expensive to produce the item, okay? So what we're saying here is anytime you change a price, it creates a cost for the business. That cost could be really small or it could be really expensive, all right? So an expensive example would be something like, I mentioned in principles courses, LL Bean. You know, LL Bean sends out these quarterly catalogs with all these prices in there. And if LL Bean wanted to change the price of something in its catalog, it would have to remail its catalogs out or send a note to everybody that it sent catalogs to. It would be incredibly expensive, okay? So that is a very high menu cost. On the other hand, you can have very low menu costs, like Amazon. If Amazon wants to change prices for an item, it's cheap. But it's still not free. You still have to pay an employee to go in, try to figure out what the price should be, and then physically go in and change it, okay? So it still takes some effort. It still requires some work. So the thing is, if you know it's expensive to change prices, you might not change it all the time, okay? If the current price is $4.50, let's say for a burrito at Bollywood Tacos, right? If a burrito is $4.50 at Bollywood Tacos, and the owners think that the ideal price would be $4.68, that would be kind of the best price for them to choose, they're probably not going to take the time to change the price, okay? Because the 18 cents in extra benefit that they get from each unit isn't worth the cost of printing new menus out. In other words, the menu cost is greater than the benefit of making the price change, okay? By the way, if this doesn't make sense to you, just think about it this way. If you go into a restaurant or you look at a catalog or go to a grocery store, are prices changing all the time? No, they're not, all right? That's because they're sticky. They do not change frequently. So let's think about the effects of an increase in money supply under the knowledge now that prices are sticky. So here is basically what happens. When the money supply goes up, obviously, people have more money. There are many different ways the Fed can change the money supply, right? But the bottom line is that money will end up in some people's hands. Some people will end up with more money, okay? Now, more money doesn't necessarily mean they're going to spend more. But in this case, it will, because prices do not immediately adjust, okay? So prices will stay constant or nearly constant for some period of time, for some short run period, okay? Maybe it's a week, maybe it's half a year, I don't know. But with more money and prices exactly the same, this increases the wealth effect that people have, okay? So people spend more since they have more buying power. And that is what stimulates the economy, okay? We're not even really thinking about classical or Keynesian economics. We're leaving that behind for right now. We're just thinking in a very practical sense, very pragmatic sense, okay? That if you increase the money supply but prices stay the same, right? So people have more money but prices stay the same, that will allow for more consumption. Now you might be wondering, how do businesses produce more stuff in this case? Well, it has to do with when the Fed would do this. When would the Fed try to expand the economy? When the economy is really struggling, when it's really weak, right? When there's lots of unemployment. Probably businesses have a lot of built up inventory. So the thing is, if a car dealership has tons of cars it's trying to sell, it will happily sell a bunch of cars to these people that now demand more, okay? So since the Fed tends to do this when the economy is weak, it's pretty easy for that production to continue. So you'll be able to stimulate the economy through monetary expansion here. If you try to do this when the economy is really strong, it wouldn't really do anything, right? It would just eventually cause inflation. So that's one reason, right? It has to do with the stickiness of prices. A second key way that the money supply affects the economy is through interest rates. When the money supply goes up, what happens to the federal funds rate? We've been drawing these on graphs, right? When the money supply goes up, the federal funds rate goes down. And what we learned in the previous video is that the federal funds rate is connected to all other rates. So let's think about why that would matter. If interest rates drop, is that going to encourage more business or discourage business? Turns out this is going to stimulate the economy, okay? Think about why people borrow money, and you might even think about why people save money, okay? So from the borrowing side of the economy, you get more of it. So you get more mortgages, more people borrowing money to buy a car, more people borrowing to start a business, okay? So with lower rates, that's going to stimulate the borrowing. I think that's kind of the obvious effect of this. Let's think now about the not so obvious effect. Think about the savers now. Interest rates on savings accounts right now in the US are basically 0%, right? How does that affect people? If you know that interest rates on savings accounts and checking accounts are going to be really, really, really low, where would you put your money? Maybe not in a bank, okay? So with low rates, people are more likely to buy stocks or other things rather than put their money in the bank, okay? So the other things could be limitless, right? It could be buy stocks, it could be to buy investment properties, it could be buy real estate, investment trust, REITs, if you've ever heard of that. Hell, it could be Bitcoin, okay? But the thing is, when you put your money in a bank, the bank has to hold 10%. But if you put your money into other assets like stocks, there's no such effect. All of the money gets channeled through. It doesn't have to sit in a bank. So this allows for there to be more economic activity potentially. So again, when interest rates are low, it affects borrowing. That's probably the bigger effect because people will borrow more. But it also generally means that money is going to get freed up a little bit more, which is also going to allow for more economic activity, okay? Because money is less likely to be held at a bank. It's more likely to be held somewhere else. Okay, so we've seen two effects now. The effects of sticky prices, all right, more money, sticky prices, people will demand more. And then secondly here, when money supply goes up, interest rates go down. All right, diving down just a little bit further here. Another one is asset values. All right, when we say asset values, what we're really talking about here is bonds, stocks, things like that. Houses, okay? The bottom line is when the money supply goes up, asset values go up as well, okay? Now, why do asset values go up when the money supply is higher? Well, when there's more money, basically everything's going to go up in value, okay? Prices are slower to adjust because prices are sticky. Wages can be pretty slow to adjust too because they can be really sticky, right? Because of contracts. But asset values like stock values, housing values, those things don't have any sort of stickiness, do they? The price of a stock changes every second. So as the money supply goes up, asset values will rise. This will make people feel wealthier and thus allow them to spend more. This is really not that different from the first example that we went through, but we're recognizing now that it's not just about sticky prices. The prices that happen to not be sticky are the ones that tend to be tied to people's wealth. So when the money supply goes up, goods and services stay the same price for a little while, but people look at their 401ks, see that it is rising because of the increase in money supply, which causes them to feel more compelled to spend more, right? That wealth effect. Just add a couple more here. Fourth one, really diving down now into the not so obvious potentials. A fourth reason is money hoarding, okay? So a fourth reason here basically explains this. When interest rates are low, when inflation is low, people may just hold money. I'm not saying put it in a bank. I'm saying they may just hold it at home. Think about why that would be the case, okay? If the inflation rate is 50%, are you going to hold $10,000 at your house? Definitely not, right? Because that money is losing value every single second. So you're going to take that $50,000, you're going to put it in a bank, which will give you some interest. You're going to put it in the stock market, right, which will go up in value, or you might just spend it, right? So high inflation would cause people to not want to hold money. On the contrary, you could have deflation. Deflation is when money is gaining value, right? It's the opposite of inflation. So if deflation is 1%, that means that your dollars are gaining 1% value every year just by leaving them alone. Would you hold money in this circumstance? You might, right? Because you know that holding cash is a good way to preserve or even gain wealth on that money. So here's the thing. When the money supply goes up, inflation goes up. And when inflation goes up, it reduces the desire for people to hold money, right? People may be holding money at their house now, but when they see that inflation rate creep up to maybe 3 or 4%, they now want to put it out there into the economy, all right? So what you get is more spending as hoarded money re-enters the economy. Whether that means it's spent or saved. Okay, now keep in mind, I think we've said this before, when we say save in the economic sense, we're not saying you hold the money at your house. We don't really call that saving. Saving means you're putting it somewhere, okay, like a bank, stocks, whatever. So that money goes from just sitting there to being spent or saved, right? That not only stimulates spending, but it also increases the money supply because the money goes from doing nothing to perhaps finding its way into a bank and multiplying, all right? So that can stimulate the economy. One more. The fifth and final one here, arguably, is the most important. Expectations. Expectations. We're going to be seeing expectations as a relevant driver of the economy many times over in this class. The thing is, people know, they've learned that increases in the money supply lead to growth in the economy. It doesn't even so much matter why. Okay, for this fifth one here, we don't even really have to think about why it does. It could be any of those other four reasons that we talked about, or it could be some reasons that we haven't discussed. But people have figured out that when the Fed increases the money supply, the economy gets stronger. All right? So imagine right now if the Fed came out and said, we're about to do $500 billion in open market purchases. Think about what people are going to expect to happen, all right? If you could sort of look inside somebody's head that's good at this stuff, somebody who works at a bank, you hear that the Fed's going to do $500 billion in open market purchases, and here's what you're thinking. All right, prices won't adjust right away. That stimulates the economy. Interest rates are going to go down. That stimulates the economy. People are going to buy stocks. It's going to drive up stock prices. People will feel it's a lot of stuff happening, right? And they all point to the same thing. When the Fed says they're going to do something like increase the money supply, people know that increased money supplies usually mean the economy gets stronger. So they will already respond to this by stimulating the economy in their own right, okay? In other words, if the Fed just says they're going to do this, that alone will stimulate the economy, perhaps even if they don't do it, all right? Don't believe me? Imagine if I told you that tomorrow the Fed said they're going to increase the money supply by $1 trillion. Would you want to buy stocks? Right? Yeah, you would. Because you would expect that that would be good news to stocks. So the stock market is going to respond positively to this because people know that it generally leads to increased stock valuations. Okay? So merely the expectation of an improved economy will improve the economy. And the reasons this could happen are multifaceted. It doesn't just have to be in the stock market. You know, let's say that I own a business, right? Let's say I have an upper end restaurant, right? If I hear that the Fed's going to increase the money supply, I might say, well, business is about to get better. So I go ahead and hire an employee, right? I already hired an employee, okay? Perhaps I'm thinking about buying a house. I hear that the Fed's going to do this. Well, I know that when the economy gets stronger, housing prices go up. So I go ahead and buy a house now before the Fed even does it, okay? So the expectations of the Fed increasing the money supply will cause people to react to that, as long as we believe the Fed. As we get to the later videos, we'll think back, does the Fed have credibility when they say they're going to do something, which is clearly tied into expectations. And finally, to close this little section that we have, we've talked about the Fed and interest rates. We've talked about Fed and the economy in general. Let's finally talk about the Fed and inflation. Okay, here's the thing. Ceteris paribus, more money leads to greater inflation rates. Okay? And to make sure that we understand inflation, if the inflation rate is 3%, that means that prices go up in a year 3%. It's based on average prices. We use a CPI, the Consumer Price Index, usually to estimate this. And it's based on weighted prices. What I mean by that is the stuff that people buy more often is counted as a bigger proportion of this. So housing is probably the biggest expense in the U.S. So housing, if it goes up 10%, that affects inflation a lot. Whereas if the price of escargot goes up 10%, it will have a minuscule, perhaps invisible effect on this inflation rate. So it counts things that people buy more often as being more important, okay? So it's not just an average of prices, it's a weighted average of prices, weighting things more heavily that people buy more often, okay? So ceteris paribus, this is true. More money means more inflation. However, ceteris paribus does not hold in the real world, right? Ceteris paribus means holding all else equal. All else never gets held equal. This is not a chemistry experiment where we have a test tube. This is a society that's very intricate, very complicated, with lots of moving parts, lots of actors in it. So we have another variable that we really have to pay attention to. It's called the velocity of money. Okay? The velocity of money is frequently defined as how often $1 is spent in a year. Okay? How often $1 is spent in a year. And you get different answers for velocity depending on what sort of criteria you're using, right? We could use currency, M1, M2. There's different ways to think about it. But let me try to explain what this looks like, okay? Let's say that M1 is $3 trillion, right? $3 trillion in currency, traveler's checks, checking accounts, right? And let's say that total spending in a year is $18 trillion. All right? Based on that little information there, what we can say is if there's $3 trillion of M1 and there's $18 trillion spent, on average, a dollar gets spent 6 times in a year. So the velocity would be 6. Okay? Now I could actually show you the formula for this. I'll show it to you real quick just so you see it. There's a formula that looks like this. MV equals PQ. In fact, let me just call that GDP. All right. Where M is the money supply, V is the velocity of money, and this is GDP, gross domestic product. Okay. So all we really need to do is take the velocity. To solve for the velocity, all we have to do is take the money supply and divide by GDP. Okay. Normally we call this MS, but I'm showing you this formula because this is something that's taught a lot of times in principles classes. All right, so that's where that 6 comes from. We take 18, I'm sorry, did that backwards. We take the GDP of $18 trillion here, divide through by M, $3 trillion, and that's where we get 6, okay? So that velocity of money is the other determining factor for inflation. There are other factors, in fact, but the velocity of money and the money supply are the two key factors. So as a thought experiment, imagine this. Imagine the money supply goes up 100%, all right? Maybe we go from 3 trillion to 6 trillion. At the same time, let's imagine that the velocity goes down by 50%. So maybe it goes down from, 10 to 5. Okay? What do you think the effects on the economy would be in that information there? How would you expect that to affect prices? Turns out prices would probably stay the same. Okay? It depends on what's happening to nominal and real GDP and that sort of thing. But the bottom line is, if the economy is staying roughly the same size, if real GDP is staying roughly the same size, what this is telling you is the amount of spending is the same. How much spending do we have when we had a money supply of 3 trillion and a velocity of 10? How much total spending do we have in society? What this is telling you is there's $3 trillion and each dollar got spent 10 times on average. So that would be $30 trillion in spending. In the second example, all right, after the money supply goes up, velocity got cut to 5. Here, if you multiply these together, you get 30 trillion again, okay? So the thing is, velocity is a major determinant of inflation rates. So if we see that money supply went up and velocity went down, they could cancel each other out potentially, all right? So what that means is, as we take this from a principles level idea to an upper level idea, if I ask on the exam something like, does an increase in the money supply lead to inflation? The answer to that question is not always going to be yes. Ceteris paribus, it's true, right? If nothing else changes, this is true. But the interesting thing is, when there's more money, the velocity often tends to go down, actually, okay? And furthermore, the Fed often is responsive to a change in velocity. If the Fed finds out that the velocity is dropping, they will then pump money into the economy, all right? So when the velocity goes down, the thing is, this is a very common situation where the Fed would want to pump up the money supply. Why is this relevant? Why does this matter? Well, if we look back to a year like 2008, all right, the money supply between 2008 to 2010 during the Great Recession, the money supply doubled. And people tend to think, well, oh, we're going to have inflation because the money supply doubled. The money supply doubled because the Fed knew that the velocity was dropping, you see. People weren't spending money much back in 2008 to 2010. So to try to counteract that, the Fed increased the money supply. So when we think about inflation, we can't just think about the money supply. We also have to think about velocity. As one more example, if the money supply doesn't change, and at the same time the velocity goes up, what do you think will generally happen to inflation? Normal cases, if it looks like this, what's going to happen to inflation? It'll go up, all right? What this is saying is there's the same amount of money as before, but the money is getting spent more often. If a dollar gets spent 5 times a year versus 10 times a year, that's twice as much spending, even though it's still just that one individual dollar. And that's what that velocity is telling us. Okay? We may talk more about this in the future. There's an interesting and very complex relationship between the Fed and the velocity. The Fed is both responsive to changes in velocity and also affects the velocity. So they're very intertwined, very endogenously related to one another.